IRR, or the internal rate of return, it's a measure for the expected return for a project. And what it actually is, it's the discount rate so that the present value of the expected cash flows equals zero. And so you want to recognize it through that equation. So you can see you've got the expected cash flows of the project, and IRR is simply the discount rate so that their present value is equal to zero. And that is a way of measuring the expected return for a project. So therefore, the IRR rule is simply to accept investments in projects where the IRR is greater than the relevant cost of capital. So if you've got an internal rate of return, you compare it to the relevant cost of capital, and if IRR is higher, you would accept it. And so here is the idea, is you have the project with a certain level of risk, and it has a certain expected return as measured by the IRR. And then you've got stocks and bonds that have the same level of risk, and they have an expected return. And so if you can get a higher return from the project, such that your internal rate of return is greater than your that you could get with stocks and bonds for the same level of risk, you do the project. If for the same level of risk, the IRR, the expected return associated with the project, is less than we could get with stocks and bonds, you shouldn't do the project. And if these happen to be equal, you'd be indifferent. For the same level of risk, you get the same expected return. Now, one of the questions that somebody might ask is, why is it possible that a project with a certain level of risk can have a higher expected return than stocks and bonds with the same level of risk? I thought we've been talking about how assets with the same level of risk should all have the same expected return, and here we're having a whole method around the exact opposite. Well, we've been talking so far on what we consider Wall Street, which are financial markets, and there all stocks and bonds with financial assets with the same level of risk have the same expected return for there to be equilibrium. If you had two stocks or two bonds or a stock and a bond or two financial assets with the same level of risk but different levels of expected return, everybody would want the higher expected return. Nobody would want the one with the lower expected return. There would not be equilibrium. The only way to get equilibrium on Wall Street is for a certain level of risk to correspond to a certain expected return. That's not necessarily the case on Main Street. All projects with the same level of risk don't need to have the same expected return. A firm can have projects that have a higher expected return than stocks. So you could have a firm either because of its know-how, patent protection, relationships it has with distributors and sellers and suppliers, that there are opportunities, natural monopolies, where it could go in, establish a project, and earn above average, very high for, relative to stocks and bonds for that level of risk. And they are protected either by, like I said, patents or, kind of legal protections or just economic protections. It may be the case where it's a kind of a one-store town and you got you decide to open up the one store. No one else is going to come in and challenge you because there's just not a big enough business, so you can charge high prices and offer poor service and nobody can really do anything about it. So there's a difference between Main Street and Wall Street, and that's why the IRR method makes sense. That projects could have a different level of expected return. Again, they could have lower expected return. It could just be a poorly thought out project that for a given level of risk that it's just not generating enough cash flow, you're better off putting it in stocks and bonds. So how do we solve? We forecast the expected cash flows. We determine the cost of capital. That's our benchmark. A lot of times it's called the hurdle rate. Find the IRR, and again, what is it? We're going to let the calculator do the work, but it is the rate such that if you discount all of the expected cash flows, the present value is zero. What's the rate that gives us that? That's a measure of the expected return. And then 4, you make your decision. If you essentially, for a level of risk, can do better with the project than stocks and bonds, you do it. If you're worse off with the project and you could be better off with stocks and bonds of the same risk, you don't do the project. and then you're indifferent. It's supposed to be an equal sign. You're indifferent if you, for the same level of risk, you could get the same expected return with the project or with stocks and bonds. So again, you can do a trial and error. You can just keep trying rate after rate after rate until you get one where the NPV would be equal to zero. Or I shouldn't say NPV, but the present value of the expected cash flows would be zero. But we can let a financial calculator do the work for us. So here you want to go to the IRR function. And so you hit apps, and then you hit 1 for finance applications, or in some cases it might be different than 1. And then you see the different functions, and on many calculators IRR is 8, so you actually have to, if you want to see it, move the arrows down and highlight 8, or you can just hit 8, hit enter, and what pops up? IRR in open parentheses. And basically the calculator is saying, I'm open for business, tell me the cash flows, and I can tell you the IRR. So the first thing you want to type in is C0, which is again the cash flow at time 0. Then type in a comma to say, okay, we're done giving you that first cash flow at time 0. Then you give it the brackets, which is by hitting second and then the open parentheses button. And so we're telling the calculator, okay, now we're going to give you the rest of the cash flows. So C1, comma, C2, comma, C3, all the way out to the last cash flow. Then you close it up with the brackets by hitting second and then close parentheses. Then you hit the close parentheses to say, okay, I'm done giving you cash flows. I'm done with the information. Give me the IRR. You hit enter. You've given it the cash flows. It'll solve for the discount rate such that the present value of the cash flows that you gave it are equal to 0. Again, there's no sign convention. If there is cash flow that's expected to go out, it's negative. If it's cash flow that's expected to come in, it's positive. And if it's a 0 cash flow, it's 0. So let's look at our finance tutor project. Remember, we put in 165, expect 65 in a year, 70 in 2, and 90 in 3. Cost of capital is 12%. That's going to be our benchmark. We don't need the cost of capital to compute the IRR, but we need the 12% to decide whether or not we should accept the project. So again, go to the IRR function, so it gives you IRR in open parentheses, negative 165,000. And again, remember, you do not want to type in 165, comma, 000. Commas mean something to the financial calculator. It says, okay, time for a new argument. So 165,000, then you hit the comma, and you're saying, okay, I've just given you C0, brackets, by doing second open parentheses, give it the 3 cash flows, 65,000, 70,000, 90,000. Close it up with the closed brackets to say I'm done with cash flows. Close the parentheses to say I'm done giving you everything I need to give you. Hit enter, and sometimes it takes a while because what the calculator is actually doing is trying rate after rate after rate till it gets to the one where the present value of those cash flows equals 0, and IRR is 16.25%. That means that negative 165 plus 65,000 over 1.1625 plus 70,000 over 1.1625 squared plus 90,000 over 1.1625 to the third is equal to 0. Well, the IRR is 16.25, cost of capital is 12%, so we accept the project. Basically, for the level of risk that this project has, we could do the project and earn 16.25%, or we could invest in stocks and bonds and earn 12%, so we're better off with the project. So what if we are going to open up the, Patriot Theaters is looking at the Boston Multiplex, 550 today, 100, 200, 300, and 400,000 in 1, 2, 3, 4 years. Would we decide to expand on IRR? The cost of capital is 23.4. So go ahead, you got the cash flows, you got your benchmark, put in 550,000. Then in year 1, year 2, year 3, and year 4, you have your cash flows. You hit enter, and notice the IRR is 22.96. In this case, the benchmark is 23.4, so we do not accept. So this example and the previous example highlights something that's really interesting is here we had a project where the IRR was 16.25% and we accepted it. This project has an IRR of 22.96%, so it actually has a higher IRR, a higher expected return, and we rejected it. And the reason is because we're not comparing the projects to each other, we're comparing the project to the expected return that you could get on stocks and bonds that have the same level of risk as the project. So the first project had a cost of capital of 12%. This one has 23.4%. This one's much riskier. So here, the 16.25 was better than you could get with stocks and bonds of the same level of risk as the project, so you do it. Here, it's a much riskier project, and even though you got a really nice IRR of 22.96%, you could still do better in the stock market or in the bond market, in the financial markets, where for the level of risk of this Boston multiplex, you could get stocks and bonds with 23.4. So it highlights how it's not the same benchmark for every project, but that the benchmark is project specific based on the risk of that project. Finally, IRR negative 500 today, 200 in a year, and 400 in 4 years. So again, today you put in 500, in year 1 is 200. Again, nothing about years 2 and 3, so that you're indicating that by putting in zeros. 400 in year 4, 6.41%. So again, if you have 1 and 4, you don't have to scratch your head and say, oh, how am I going to tell the calculator what's going on? The way you do it is by putting zeros in there for years 2 and 3.